when we look at springs and up thrusts, they occur all the time, and people can easily get confused by them. And so I put this together to really clarify the spring and the up thrust trade. They are lovely trades. I really like them a lot. They are my bread and butter trades. And so I think that every trader should trade. But I want to spend some time going over them in some detail, because I think that there are 8 important, I'm calling them data points here, key ideas, key concepts that you need to understand when trading them. Okay, so keep these in mind, and springs and up thrusts can become the same kind of bread and butter trade that I get off of them for you. So the first one here, and we're going to just focus on springs. It's the exact reverse for the up thrust, but it would take too much time to go through all of it. So I'm just going to talk about springs, but you know that the reverse is true. You just do everything in like a mirror, a reverse mirror image, and that sets it up for you. So the first important point, or the first key concept here, is that they work best in certain situations. And of all of the situations that they work well in, they work the very best in trending conditions. Doesn't mean that they're going to be 100%, but they're going to have much higher odds when you're taking a spring in an uptrend or a up thrust in a downtrend. And we've seen a couple of examples of that already. Okay, so again, it's the high low, higher high, higher low, and that spring that's occurring in there, or at some higher high and higher low, the spring is setting up for us. That's the thing that we want to, that's when they work the best, the very best. They become even better when we're in that uptrend and we retrace to looks like a little cockeyed there, sorry. We retrace to a prior resistance area that now becomes support. Okay, and this is typically an excellent trade. As I said before, in the up thrust, I think in gold that I like this look in particular because we get the lack of follow through at, in the case of a spring, significant support. We get the lack of follow through in the case of an up thrust at significant resistance. Okay, in fact, this is my favorite spring setup. If I had to pick one trade setup that if you only gave me one and I could choose the one, this would be the one. And so we've got trending conditions, the market retraces back and it comes back into what had been prior resistance and now is support. The third important data point here is that springs and up thrusts don't have to just be taken in trends. They work well in extended trading ranges as well. So they frequently define the edges of a trading range. So you're really getting in at the very edge of the trading range, either the top or the bottom. If you're in a trading range, when we say that the up thrust is going to take out the last swing low, or the spring is going to take out the last swing high, you can modify that, and what our target really is going to, in the case of an up thrust, it's going back down towards the bottom of the trading range. It may not get all the way down to the bottom, or it may actually go through it, but you're looking to get down into this area somewhere. And the spring, you're looking for it to get up. So it may take out the last swing high or the minor swing low inside the trading range. So that changes things a little bit. For targets, if the market can't get above, if it's come up once and then a second time, and sometimes you see this come up 2 or 3 times, if it makes a high and then it comes up and it can't get above that high, then it's got a right, so to speak, to come down to the bottom end of the trading range, and vice versa for a spring. So when the trading range forms in a downtrend, you can take the up thrust fairly early after the trading range forms. And we saw that in the gold. Go back to Tuesday's gold upthrust. And it occurred fairly quickly after that little trading range formed. Don't do that with a spring. Springs in an uptrend, in a downtrend, generally are not a good idea unless you're in an extended trading range. And so you've gone for a while, right? And the spring sets up, and in a trading range, in a downtrend, and you've got a trading range, make sure that that downtrend line has broken. So I don't know where one would be here in this conceptual, but let's just say that the downtrend line was, I don't know, something like that. So now it's been broken, right? And you can feel more comfortable in taking a spring. So you want the trading range to be extended before you take a spring, and you want that downtrend line to be broken. And the opposite, of course, would occur in an uptrend with an upthrust. Makes sense, I hope, for you there. But I'm giving you sort of some of the nuances here of these. And it would be your job to go back and do some personal research and look at springs that occurred over the last, I don't know, 4, 5, 6 months, if you're day trading or whatever, and see how these things, try to identify some of these key data points that I'm talking about here. Okay, so now if the last swing high is characterized by diminishing demand, or the swing down to the spring has supply, okay, so here we have sort of let me get a different pen color. Here we have shortening of the thrust in the waves, right? You can see that this wave up was nice and large. This one's gotten smaller, and this one's gotten smaller as well. And we're just not making progress up. Also, the up waves, this is volume. This is supposed to be volume for the up waves. Nice and strong here, pretty good here. Look how weak it's getting. Look how weak it's getting. And then on this leg down here, this spring, we see a pickup in volume. Ooh, that's just not a good idea. It may actually close above the swing low, but it's just not something that I would try to take. So really what we're talking about here is sign of weakness that's occurring. And in this case, we're talking about shortening of the thrust. We also had on that gold up thrust, I think, that Tuesday where there were 2 up thrusts, we also had climactic action. I mean, that could play into this as well. So if a spring did set up, in fact, go back to that chart and study that. Even though that spring worked out, this is the kind of stuff I'm talking about here, was that Tuesday gold chart where we had the 2 up thrusts, but we also had a spring in the middle. Okay, so stay away from springs in this situation. Even if they work out, it's just not in our playbook, and we don't do it. Or that's how I would think about it. It may happen, and it may be successful, but that's not my play. Thank you. That does not favor my play. And I can tell you from experience that these things just don't work well. Okay, and we said that in a downtrend, when supply is dominant, either by price action, swing length, or volume, or all, or some combination of those. So swing length, you can see the down legs are stronger or longer than the up legs. The volume is growing to the downside. And price action, we don't have price action, but you would see that there would be good downflow, ease of movement on these legs down. And then, the odds of success, just not, even if the volume dries up over here, it's just not there. In a downtrend, you don't want to be where supply is dominant. You just don't want to be taking springs. And the reverse, of course, is true for an up thrust. We see up thrusts all the time in an uptrend, and it's usually just a little bit of supply coming in where traders are taking profits, and then that sets up a little bit of a pullback, and people think, oh, it's an up thrust, let's go short, and then they're in trouble. Okay, the 6th important data point here for springs is you get a spring, And it's, it generally looks good. It's got all the good characteristics. Maybe it's in a nice uptrend, there's good demand behind it, and so on and so forth. But then it fails to rally away from the danger point. And I don't mean just fail, but it's hanging around here. And you've got a bunch of price action. You got a bunch of price action, price bars in here. There's just no liftoff. Well, something's wrong. Now, this will most often allow you to get out gracefully. In other words, you'll see a lot of overlapping price bars in here, a lot of back and forth, 6, 8 price bars, 5 price bars, something like that. You'll have a chance to get out at break even and not get hurt. So it will allow you to get out gracefully, but you've got to be aware that if it's hanging at the lows here, hanging at the danger point, and we call this the danger point. The danger point is the lows right here, is the low right here. So it's just hanging around that danger point. It's going to, more than likely, more often than not, it's going to roll over and come down on you. Something's wrong, okay? You've miscalculated, or the market just is acting weird that day and doing what it wants, doesn't care about springs or any of the Wyckoff principles. Okay, the odds are good that it's going to go down. Okay, number 7. Traders ask me this a lot. They see a significant reaction down below the swing low. Well, when you see a large reaction down below the swing low, the odds of success are pretty low, pretty thin. And it may very well close above, you may get a close or two above the swing low. But if you've got a deep penetration here, it's just one you want to pass, okay? It's one you want to pass. For a rule of thumb, for those who need specificity, I mean, I just eyeball this. I never do this. But the rule of thumb is if it's 150% of the length of A, if B to C here is more than 150% of A to B, or more than 1.5 times A to B, then don't take the spring, okay? But truthfully, you don't need to calculate it. You just can see it. And more often than not, you're going to see high volume come in on the downside as well, because you're breaking lows and you're starting to move down. And it may be just one bar. I remember, back quite a ways back now, probably, I forget, around 2002 or 2001, we saw a spring set up in the NASDAQ. And let's say that this was the swing low here, just extended out, and it had this price bar like this, and it closes like this huge, massive price bar, and it closes right up above it. And people said, well, we should take that as a spring. No, because that was supply, and it went up a couple of days. This was on a daily basis, and then bang, it came down hard. So don't get seduced by that. Make sure it's a good-looking spring. Okay, now for the aggressive trader. We said that springs work best in uptrends or in trading ranges. Now I'm going to show you that they also can be very nice in downtrends, but you want to have as many of these signs of strength as possible. The more, the better, okay? So let's go through them. The first would be a selling climax. We talked a little bit about that in the gold charts. Climactic action down in here to stop the down move. You're in a downtrend, okay? We're in a downtrend. We're going lower, high, lower, low, all the way down. But we have some stopping action down here. So that's one thing that is very useful as a selling climax. Being oversold in the trend channel. Coming down underneath that trend channel is also a indication that we have overshot or overreached the downtrend. The crowd has overreached the downtrend. And it's a signal that the downtrend is coming to an end, if not over at that point. So being oversold. And oversold means going through, in this case, it means coming down through and underneath the demand line of the trend channel. This is the demand line. This is the supply line. Supply comes in here, demand comes in here. Well, we get way into the demand, where demand should show up. We get way into it by being oversold. Next is strong demand on the last rally, and this is the last rally here. And we can see it in a number of ways, but one way is if we look at the wave up here and compare it to the last wave down or the last couple of waves down, last couple of waves up, excuse me. Not here, but it should be like this, right? This is going to be larger, okay? This wave up is going to be larger. We want to see that. Why? Because it indicates, as we've seen earlier, it indicates demand is overcoming supply. I like to see good, solid demand volume coming in. Doesn't have to be bigger than the climactic volume, the downside climactic volume, but it's got to be large. This has been the typical volume on the up waves in the downtrend. It's got to be bigger than that. It's got to stand out. Okay. I like to see this downtrend broken here. That's important. The reaction back down is choppy. Lots of price bar overlap. It's not coming swiftly down the way it was here. Now it's taking its time coming down. And the volume is lower, much lower. You're going to see a lot of little waves in here if you're using the Weiss wave, and there's nothing going to compare to what we saw down in here. Okay. And then you get the spring, we get a little rally up, and then you get a test. That's all. So all of these, as many of these as you've got, as you can, and I would say the most important are this. Either climax or oversold, either one is okay. This with the good demand, the light choppiness coming down, those are the key things that you have to have. Climactic action is nice. Test is nice. We don't always get it, but you get the idea. There's a story of demand that shows up here in this. And so if you want to look for trades right at the bottom of the downtrend off of a spring, this is the way you can do it. Okay. So stick with these 8 data points and for springs and up thrusts, and you should see most of these trades work pretty well for you if you keep all this stuff in mind.